Hi everybody, this is Dennis Wilborn, the founder of Active Trend Trading. This is the 1st of March 2020. I'm calling an audible for our regular training session that we would post to YouTube channel Market Tech Talk for Active Trend Trading. And what I'm going to do is I'm going to talk about the basically double-digit drop in the market that happened last week due to fear and overreaction to the coronavirus. I want to basically help traders in this video discover how to use past corrections and past bear markets to give some kind of a clue of whether we want to buy this market or sell this market, because we should see some distinct patterns show up regardless of which way we want to go. So if this is your first time on Market Tech Talk, please hit the subscribe button down below and also ring the bell. And then when the chat box comes up, just let them know you want to be notified when new content is posted from me, the Active Trend Trader. So with no further ado, let's find out when it's time to get in this market. Hey, let's dive right in, guys. This is Dennis. Back again. I want to basically kind of help everybody understand what's going on when we're having a correction. And what do you do when you correction? Corrections are typically moves the market that are greater than 10% off the highs. Well, we had one of those last week in all of the indexes, but I want to take a look primarily at the S&P because it's, it has a large number of stocks in it. It fairly represents the broad nature of the market, and so that's what we're going to be identifying here. What we want to do is when you get a correction of 10% or more, and then if the correction goes on into a 20% correction, that basically is the definition of going into a bear market. Across history, we've had some of the major significant bloodiest times in the markets. There's only about 3 or 4 of them since actually 1929, when we had the big bear market fall that led to the Great Depression. And again, there's been like 3 or 4 others that have been little, what you'd call minor correction, or they're not minor when you're suffering through it, but each correction in turn leaves clues. And so one of the things we want to do when we see a correction like's happening due to the coronavirus, we want to look for past corrections and recognize that corrections always overreact. In other words, if the market is selling off, it will sell off too much. The market itself works around what you call a mean moving average. A lot of people take the 20 or the 21 or the 50-day moving average to be the mean price of the market, the average price of the market. And they expect prices to react back towards that mean, whether or not they are way below the mean or way above the mean, that as the market goes through its normal iteration, it will move consistently around that mean. That's why I want to be paying attention to the moving averages, because those are oftentimes where you get your best trigger points. So we want to look at past performance, past corrections. Learn the specific patterns. I'm going to show just some basic patterns today that will help you navigate the choppy, volatile waters that we find ourselves in right now. Don't be in a hurry. This will pass. We will, the correction that's going on. It may get deeper, it may not. We shall see. Right now I'm watching the futures and they're just slopping around last Friday's low, but they're moving 300, 400, 500 points, and it's pre-market. It's after hours market. It's watching the market in Asia wake up. It will watch the market in Europe wake up. And so between now and tomorrow morning, Monday morning, when the New York Stock Exchange opens, there'll be a lot of sloshing around, a lot of volatility. So I want to learn the patterns, and that by learning the patterns will help me be patient. Secondly, buy the correction or sell the correction. We have to answer that question. And it will depend on what is going on with the price action. We'll show you that on the charts coming in here shortly. Lastly, corrections and bear market reflect one simple thing: human behavior, human reaction to fear, greed, all the emotional things that are wrapped up, and that's what a lot of times will drive these overreactions in the market. But in all cases, they always lead to opportunities, sometimes of a lifetime buying opportunities that we want to be prepared for. If you're wondering, how do I get prepared for that? Well, you want to take a look at active trend trading. Come visit me at the Active Trend Trading website, and we can get you hooked up for how we do it with a very successful trend following and trend trading system that we've developed going back, well, many years. So human behavior, what does that mean? Well, I took this weekly chart of VMW, and basically the human reaction is what generates these patterns that we see on this particular chart. And the patterns are fairly succinct, and I'll just show them to you right here. It's basically you get a little pullback pattern here, and then it rebounds. Goes sideways, goes up a little bit, pulls back a little bit, and rebounds. And each one of those little pullbacks and rebounds reflect what the emotional state of the individual buyer and sellers are for a particular market. Now you might say, and this is a current chart of the weekly on VMW. I think it goes out to July 2019. So it continues to, you still get these reactions. Pull back, go. Pull back, go. And so those are patterns that repeat themselves. And so learning to understand how those patterns works is what we do with technical analysis. Now you may be saying, well, Dennis, that's all well and good. That works very well on a chart that is, recently. But things are different now. And to wit, I have to run up the BS flag and say, no, they're not. Because look here, this is a chart that I borrowed from IBD, How to Make Money Trading Stocks, edition 4. This is one of my favorite stocks. Why is this one of my favorite stocks? Because this is Tennessee Coal and Iron from 1898. Do you see anything similar to what we saw before? Yeah, you get these sell-offs, reaction, reaction, rally, reaction, rally, reaction, reaction, rally. Guess what? Human nature. And what makes it very interesting is this chart pattern that we see here was was not reflective because they didn't have computers back in 1898 that would give you these really beautiful charts. They'd have to, if they were drawing the charts, they'd have to do it by hand. But isn't it interesting that it's the same underlying human behavior that drives the price action? So you might be saying, well, Dennis, yeah, you're just cherry picking out of what is available out there. Well, let's take another look. Let's take a look at this. This is the stock prices of the Dow. Stock prices of the Dow. Well, where does it go back to? 1797, just about the time when, or actually 1781 is when the exchanges, kind of opened up. And what do you have? You have human nature driving these patterns. And what do the patterns look like? Sell up, reaction, rebound, reaction, rebound. Big reaction. Okay, that was the fall of the 1929 sell-off that led to the Great Depression right there. Where was 2000, where the market fell out of the sky? Well, 2000 is right there. And as you can see, yeah, in 2000, it went on to about the end of 2000, and then we got this sell-off here into 2000. Well, where was 2008 and 9? Well, they're right there. And where are we right now? Well, we're a little bit higher than this. As of 2013, we're continuing to press higher. But as you can see, the ebbs and flows of the market due to human behavior, human interpretation, have been there as long as there's been markets. and human beings have been involved with them. So just something to take aside, learn something that and go, okay, so what we'll be seeing now, regardless if we're having computer trading or quant trading or anything else that is we think may be manipulating the price action, the fact of the matter is it's still ultimately driven by human nature. So I wanted to make a big point on that before we go in and start looking at the charts. So let's go on over and look at the charts now and see what can we learn from a chart of the. And so what I wanted to start with is basically the I'll do the SPY. It's the spider. No, I'll take it back. I'm going to do the SPX. Because that reflects 2,000 stocks, or not 2,000, SP 500. It reflects 500 stocks. And people ask sometimes, why, Dennis, do you do the 500, S&P 500, the NASDAQ, and the IWM, the Russell? And it's partly because they cover more stocks than the Dow 30. They, I think, provide a more accurate reflection of what's going on in the economy. And there's several other reasons I won't go into right now. But let's take a look at what we see going on with the weekly chart. Well, as you can see, last week, the S&P gapped down and then fell. Now, what I want to do is take a look. When you see something like this, again, go to a weekly chart. And what are we looking for? What did past patterns tell us? Well, if we'll refer back to over here, this was the correction that we went into in October of 2019, which looked like it was going to be a blowout correction to the downside. It got down to about 20%, so it was on the cusp of being a bear market, but then rebounded. It just took off out of here, and it basically did, the market did exceptionally well. You got the regular little rally up, reaction down, rally up, reaction down, and that continued on. So we'll look back. One of the things that when you get a large sell-off like this, one of the things you want to look for is where is support? Where is support? And as you can see on this particular chart, support, it fell on Friday. This is a weekly candlestick, so on Friday it fell all the way down to here. And you look to your right, correction to your left, and what do you see? You see a complete level of past areas where it found support and rebounded. So that's one, okay? That's one area. Now, the last time it fell, significantly, fell hard below the 40-week moving average, was equivalent to approximately the 200-day moving average, was back here in October 2019. What happened? Well, price actions went into a nice little consolidation pattern or a box pattern right there off the lows, up a little bit, and then finally broke out the bottom for a further move down. Could we see something like that here? Well, yes, we could. We could see a move. Let's say that this lows here hold. We could see a move back up to the 40-week moving average, which is equivalent to the 200. We can see a move back up there. Let me get rid of that. We can see price action move in a little box from there to there, approximately. You can refine these. You can refine your drawings on your own here, but stand right and go back up to the 40-week, hit its head, and then fall. Hit it, and then come back down to this support, hit the support, and bounce back up. As it did over here. It did this for 1, 2, 3, 4, 5, 6, 7, 8 weeks. So for 2 months, it followed that kind of pattern until it finally broke out the bottom. And so what a person's looking for is if it breaks out the bottom, we're going to probably go lower. But how do you trade something like that? Well, on a The way you can trade a pattern like that is one, let's go over here to the daily chart. And I'll show you what to look for on the daily chart. Actually, I want to go click. There we go. Now, as you can see on the daily chart, and here was that line of past support down here at about, bringing it up to, let's say about 28.50. So what does that look like? Well, I'm going to do one thing. I'm going to go back over here. I'm going to take I'm going to highlight my 40-week moving average. I'm going to put a line in there. Actually, I'm going to draw a complete wedge in there for the time being. And that way that will transpose over to my daily chart. So there we go. There we go. And so with an anticipation like this, if that's the box or approximation of support at the bottom, resistance at the top, and we could anticipate a price move in that, how large would that price move be? Well, I can lay in my price there at the bottom, draw up here to the top, and it's about a 7 to 8% move. So as you can see, that's a significant move for the S&P. If you're trading the 3-time leveraged ETF that reflects the S&P, that means over a 2 to 3 day period, if the volatility remains as it is, you're going to be at about a 20% run. So that's one. So I want to be interested at this point, recognizing that, yes, I could buy close to these lows because my momentum indicators on a daily chart are starting to turn back up and look like they're hitting a bottom. So I can anticipate, yeah, this is where I can trade this. But I want to adjust my expectations. If I think, or if my expectations are to, yes, I'm going to buy it here and sell it back up here, I mean, that might work over time, but it also, one thing to keep in mind, typically the market goes up about a third as fast as it goes down, approximately. So if it took us these few days to get down here, it could take us, several weeks and or months to get back up to that level, if we get back to that level at all. What's more realistic is to say, well, if I get back up to the 200-day moving average, or maybe up to the 820, here's the 8-day moving average falling down, the 20 days right behind it, because then I would want to be looking to trade this to the downside. Or if I bought it here, that's where I would want to take profits, recognizing and there's a term for this kind of trade. It's called the reversion to the mean. Price actions are way extended away from the means. The 20-day moving average, the 50-day moving average, that's that gold one. The 20-day moving average, which is the reddish colored one, and the 8 days. So it's very extended away from there. Absolutely normal reaction for it to want to bounce back up and hit into those means. So a reversion to the mean. Oftentimes you will see that move, a reversion back up into the mean, and then what happens? A reversal from there and fall back down, fall back down. You see that often in, it reflects not only in the indexes, but also in the individual stocks that you may trade. You see one, here's a good one over here. Or actually there's one right here, just earlier in January this past year, we get a breakdown below the 8-day moving average and we get a fall below the 20. What happens? We get a reversion to the mean. It rolls all the way back up, hits the 8, spins off and rolls back down. Very common. So there are two opportunities for you to look for trades, is basically to take this trade at the bottom of the, around the bottom here. What happens if this isn't what happens if this low here isn't the ultimate low that we're going for, and it doesn't go back up and test into these areas? Well, if that's the case and it breaks below that, if I take a trade on this, on the the spiders. I'll switch over to the spiders just to show us the same thing, but on a little, because you'll be more likely to buy the spiders. There we go. And so similar type situation, buy the spiders, and I'll lay out the same little box. Excuse me. Okay, there's the box. There you go. And then, okay, so I'm going to go up here to the 40-week moving average, and I'm going to just draw a line across here. Back down to approximately the bottom there. There we go. Pow. Now I'm going to go back over to the daily chart, see where it could operate within there. So if I bought the spiders right here, where would I want to put my stop loss? Well, my stop loss would basically be immediately below the low here. So the low there is 285.54. I would put a stop loss probably at 284.90. That would be my stop loss. That's if I bought it down here. Now again, we would anticipate a bounce back up and a reversal. Another way so that would be buy here, sell here. Buy here, sell here. Not a and that would be how we would target the trade. Now, do I have to sell everything right here? No, you don't, because occasionally it would go up here, hit the moving averages and fail and fall back down, but not go back down to the past lows. And so and then reverse and go higher from there. We'll see. If the coronavirus is resolved in a positive manner, in a quick, fast manner, we can anticipate a move higher very rapidly. And all of this would be erased in short order. So let's go back and look at, I want to go back and look at a couple of more opportunities here. I want to go back and look at primarily 2008. What happened in 2008? That's when the big, excuse me, that was when the big, last big bear market took place. Let's go on back. There we go. And as you can see, what happened? We basically failed. This is the end of 2007. We failed. We broke back up. Rolled back up into, approaching the mean. This was the 8-period moving average on a weekly chart, which is equivalent to about the 50. Fell down, broke back up. Again, hit the 40-week moving average, fail. But look at this failure. It dropped for 1, 2, 3, 4, 5, 6, 7, 8 weeks. And then what did it do? After the 8th week, it reverted to the mean of being the 20-week moving average. Then once it hit that mean, it fell from there. Again, similarly, it finally found its low when all of the momentum indicators got down into their lower reversal zones. And even with that, the severity of this move down, it still took a fake out low right here, pull back up to the mean. This time it was the 8-week moving average, and then a final fall down here, which led to the ultimate opportunity of jumping on the long side of the S&P back in March 2009 at $70. And so as you can see, that's one heck of a move. Let's take a look at it on one more time frame, and then we'll knock off. And I want to take a look at that just basically on the monthly. Since we are at the beginning of the month, we can do that. We've had a negative reversal up here on the monthly. But look what, look, this longer term trend line is still intact. This is from the low of October 11th, October 2011. going up to this low here. That's one trend line. We also want to be aware, though, that there's another trend line that is down here at the low. You can peek it into that low right there. Excuse me. And then I'll extend that. I might extend that. There we go. And as you can see, now that provides us a secondary low, secondary trend line. So as long as this longer-term trend line that I'm identifying right here, right there, which you also see up here, as long as that stays intact, then ultimately the longer-term trend is still in effect. We're still, by definition, still in an uptrend, longer-term uptrend. Now, if we come back down here and break through this to the downside and then come up, that could, spell another story. But as you can see, this is how I would assess, and this is how I go back and look at what happened the last time we get a huge sell-off like here, got a big sell-off here, and one here. The other thing what we want to do, though, is keep in mind and I'm going to go ahead and I'm going to get rid of that one, I think, is what's the percentage of the drop? Oftentimes people will get wrapped up around, oh, we dropped 1,000 points, and oh, it's the biggest point drop we've had since blah, 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 and which is absolutely almost a meaningless calculation because you want to know what the percentage was. And so as we see here, last month we had from a high to low, we ran from that there, so 15.79% move for the month. What about some of these other moves down? Well, the one back in, what was that? September 2018 from, if I can grab it, hold on guys, there we go, 20%. We talked about that one. It got on the cusp of being a bear market and then reversed. What about some of these other, what about this one back here? That one was 24%, or yeah, 21%. What about the one back in 2007, 2008? That was a solid bear market that scared the heck out of a lot of people. How deep was that? Well, that was 57%. So as you can see, from the high to last week's low, we're down about 13, 14%. Nowhere near what we see right there. So the fact of the matter is, how long did that take? That took 517 days to go from high to low. That's a little bit over a year. So, right now, the uptrend is still in place. Yes, last week was a significant sell-off, a significant correction, but let's see what transpires here. You have two patterns you want to be looking for. Is a bounce off support, past support and or proven support, up to where? Up into resistance form by the overhead moving averages, the 8, 20, and 50. So if we get back up to the 8, 20, and 50 first, that will give us an opportunity, look for an opportunity to take a bearish trade to the downside at that point. And if we get into a longer term downtrend, that would be the pattern we would look to take advantage of, and it would look something like this. And I'll just leave this with you for the last pattern. Let me go back this way. Is that pattern would look something like this. Is we get a bounce back up in here, a reversal, a bounce down, a reversal, a bounce down, a reversal. And these bounce ups would come up into the moving averages or approach them, either the 8 to 20 or the 50, or in this case the 40, all the way, and you could track that all the way down to where? Well, this 2018, that's a good target to shoot at. And that's one of the things that I will also, so that's the new pattern we'd be looking at. Whereas on the uptrend, we were getting this pattern that looked like this. Rally, react, pullback. rally, pullback, rally, a little bit of a pullback right there. And that was, again, and these, oftentimes you hear these talked about as waves. That's exactly what they are. So hopefully that'll leave you with some concepts, some ideas. It is not the time to throw the baby out with the bathwater. It is the time to just basically say, okay, I have two places. When the markets turn like this, I identify two areas, two value zones where I'm interested in taking action. In between those two areas, I stand aside and let the market do what it wants to do. Let the newbie traders do what they want to do, and because I'm not going to get chewed up in this market, I'm just not. And so, one of the other things that we'll take a look at, how what happens? How does this fall here? For this fall to equal this 20% loss in 2018, what would it have to look like? Well, yeah, let's go over here and have some fun with Fibonacci real quick. And we go up here to this high. Excuse me. Connect this low there. There we go. Connect it back up to the high that we just had a couple of weeks ago. And with that, as you can see, it could approach down at this level here at about 278. Would be 100% retracement here, a little bit, and that would be a 20% retracement. On the flip side, and then again, another downside on that is oftentimes it will extend and reach down to the 1272 extension. So those are both in play. But right now, as I look at the futures, the futures are up a little bit, but we never know what tomorrow morning is going to bring. So with that, I'll bid you adieu. I hope you find this video helpful. If you do, let me know about it. Drop me a note. Give me a thumbs up. And again, if this is your first time to the Market Tech Talk YouTube channel, subscribe, hit the bell, so you'll get notified of when we have new content. Aloha. God bless everybody. My house to you, I just want to say aloha, thank you, God bless. And if you're not subscribed to Market Tech Talk channel, that's the big red bubble down below. You can also register and get your free Power Rank Elite Watchlist here, and a little icon will come up right there. And over on this side over here, I have a couple of other videos that are of interest that we put out through Market Tech Talk. And so until next week, aloha, see ya.